Stephanie Budijono. I'm the lead mentor at NSF I-Corps Northeast Hub. And today is our second Entrepreneurship Essential Series webinar. And the series is basically designed to highlight important topics surrounding early stage ventures and was launched actually very recently, this year in April. And the first webinar was on creating a compelling pitch deck. And it was by Alan Weber and Glenn Getty at Robinhood Ventures. And just in case you missed the first webinar, you can find the video recording, in the very near future on our NSF I-Corps website. So today we're honored to have Mark Poag and Jim Cohen of Fitz Gate Ventures, and who will share with us what it takes to raise first rounds of capital. If you are an entrepreneur, especially with technology coming out of universities, you might want to check out our first customer discovery program at NSF I-Corps. And with this, I'd like to introduce you to our hub coordinator, Mark de Guzman. Go ahead, Mark.
Joining us. Yeah. If you're able to help with the spotlighting, I'm just having challenges because I'm sharing screen. Yeah, thanks for joining us today. I just wanted to share a little bit about our Northeast I-Corps hub. We are part of the National Innovation Network. We are the Northeast I-Corps hub, which span the 4 states, including New Jersey, Pennsylvania, Delaware, and Connecticut. And we really want to help promote an innovation entrepreneurship ecosystem in the region. We are trying to help support our innovators to bring their technologies forward, whether it's from university labs or from the community of inventors in the region. We want to connect you with the resources you need to move your innovation forward. We do focus on diversity, equity, and inclusion, and we're super excited to meet you and work with you. So feel free to put in the chat what school you're from or what innovation you're working on. Just like to get to know you a little bit better and hopefully build a relationship with you so we can help support you and make your innovation dreams come true. And so in I-Corps, which is the National Science Foundation program to train scientists to think like entrepreneurs, we help you explore the commercial potential for your innovation. You can receive a grant of up to $3,000 at the regional level to do this customer discovery activity, to get out of the building and meet with them, to understand what their needs are, so that way you start building what they are looking for. You get mentorship and guidance, and it's actually a fast track to help you advance your technology forward to the National I-Corps and get the $50,000 award and higher success rate in SBIR, which is Small Business Innovation Research Grants and Technology Transfer Grants, up to $275,000. Basically, top 10 business mistakes we see with startups is building something nobody wants, right? You are building something because it's really cool, but you recognize that there's not enough market demand for it because you haven't really tested the market. You're just focused on the technology. So the I-Corps really helps you learn about what the customer needs and how to communicate with them, how to effectively ask them questions and validate that you are solving a real world problem rather than just building something cool that nobody wants. So we want to help you get there faster, accelerate that process. And basically, they don't just like it because you build it. You have to understand what their needs are. As an entrepreneur, we want to make sure you're doing that the right way, and we give you the framework and the tools and even funding to help support you in determining whether not just whether it'll be valuable, but who will it be valuable for and why. And so the idea is that you think people want it, but you have to really test it in the market and go out and meet with folks to better understand their needs. There's various on-ramps and off-ramps for entrepreneurship and bringing your technology forward. Usually when you start with your innovation on the top left, you go through regional I-Corps, get the $3,000 to do the customer discovery, go to national I-Corps, get $50,000, create your startup, do SBIR, phase 1, phase 2, and then you can get angel and venture capital investment. Again, this is just a roadmap, a lot of on-ramps and off-ramps with different programs from the region, but I want to let you know that you're starting here if you're an innovation, and we're happy to help you anywhere along this pathway. 2 main programs that we have are the Novus I-Corps program, which is a half-day program followed by self-paced coursework run at a different university, and that's in person. And then there's a Propellus I-Corps, which is a virtual 4-week program to help explore the opportunity of the market potential. And we give you the $3,000 to get out of the building, maybe go to conferences, But the idea is we're gonna give you the license to get out of the building and meet with folks and talk to strangers to really understand what their needs are. And we'll give you mentorship and guidance along the way. And usually an I-Corps team requires 3 team members at the national level. But for our regional focus, we want technical leads and entrepreneurial leads, which are usually the faculty member who's developed the technology and the entrepreneurial lead who's a student. Industry mentors are not required at the regional level, but required at the national. And so we've got a couple of opportunities here. There's a clean tech cohort in cohort 10 starting in early July. There's a standard Propellus cohort starting in late July. And we can put links in there, but I want to get to our main event. So I just want to let you know that there is a Hub newsletter. You can follow us on the Eventbrite page. A lot of different ways to get engaged, but definitely share this opportunity with folks if this is your first time hearing about I-Corps. And just want to put the dates out there. June 19th is the deadline for the clean tech cohort, which is coming up soon. The Propellus cohort deadline is June 29th. If you have any questions, you can email me, Kate, or Vanessa. I'm happy to answer any questions, but I do want to give it to Mark and Jim. Thank you again for doing this Entrepreneurship Essentials first raise with us. We're excited to hear what you have to offer. I'm going to stop sharing, and then Mark can share his slides.
Great. Thank you, Mark and Stephanie, for the opportunity to present. Mark's going to be driving here. I think there are just basically 3-ish parts to our presentation today. The first part, we'll tell you a little bit about our firm. I'll do that. Then Mark will talk about the different different types of capital available to startups. And then I'll specifically focus at the end on venture capital and kind of what's necessary. And then we're going to try and kind of breeze through this pretty quickly. There's a lot of material here. We'll try and go through it quickly, though, so that we can leave time for Q&A. So Mark, let's go to the first slide. Fitz Gate Ventures is an early stage venture capital firm. So we manage about $40 million. We write checks, initial checks of $500,000 to $750K, and we reserve for follow-ons. By seed stage, I mean we invest in the earliest stages. We're vertical agnostic, meaning we invest in all verticals. One reason why we're doing this presentation today is that we love I-Corps. We love tech transfer. We have 20 active portfolio companies today. Probably about a quarter of them have roots in tech transfer. We've got a quantum computing company that we invested in, a photonics chip company. We've got a biotech company, a SaaS software company, all tech transfer. And in some cases, we were the very first check. So even though I say we're a seed stage firm, if it's a tech transfer opportunity, we might be pre-seed. We might be the first and only check. And we've done that several times where we have a lot of conviction. Our results have been really extraordinary across our first 2 funds. We're really pleased to say, unlike some of what you're probably reading in the paper today with SoftBank and Tiger Global, where they're writing down 30 to 50% of the valuations in their portfolios. We've maintained, even in our later stage investments, all the valuations. We've had no markdowns. And I think that's kind of a testament partly to tech transfer opportunities that are solid, really great companies, and some of the others we've invested in. Next check, Mark. Next check. Next. Mark and I come from different backgrounds. You guys can read this separately, but in short, my background's always on the investing side. I was a later stage investor for most of my career, and Mark was a software entrepreneur. So he's got that entrepreneur perspective. Next slide. One of the things we do, and when we invest in a company, we add value in different ways. But one of the main ways we add value is what we refer to as the network effect. You know, every VC fund that you pitch or that you want to take money from should be adding something more than just cash in a perfect world. And what we bring is our network. And so we've got an extensive network of a few hundred folks that we call friends of Fitz. You can go to the next slide, Mark. They're basically these are some examples, but they tend to be, in some cases, faculty members at universities or administrators involved in entrepreneurship, or most of the time they're founders themselves or venture capitalists. And we tap into this network because, one, we share deal flow, but also all of these folks are doing this because they enjoy doing this. They're not paid. They're not necessarily investors in our fund. Sometimes they want deal flow. Sometimes it's more experiential. And it's really been a powerful tool for us as generalists in order to develop expertise in areas where we may not have it, for example, in quantum computing or photonic chips. But we do tap into experts in those areas, often at leading universities. Next slide. You can read this separately, some of the great things our founders have said, but we don't need to dwell on that.
I would just point out, Jim, you had mentioned the tech spinouts, and two of these companies are spinouts from university. Rob Sholkoff, the quantum circuits, was a spinout of Yale. He's a professor at Yale. And then Daniel Powell, that was a spinout from Princeton, from the Orphy department of Princeton.
Yeah, that's great point. And both of those companies, we were the first and only check in. And then very quickly, they raised multiple rounds from some of the best investors in the world. Next slide. So here's an example of some of those investors. For example, after we seeded the quantum computing startup out of Yale, Sequoia was one of the investors who came in and led the next round. In the case of the optimal dynamics one that Mark pointed out, we've had Bessemer in that deal. Coke Disruptive Technologies came into our photonics chip company. And these are just a handful of some of the others. But the reason why I like to highlight the names of some of these firms is that you may not have heard of Fitz Gate Ventures, but you've certainly heard of some of these firms. And what that says is that the companies that we've invested in, we're pleased to say, are not just attractive to us, but attractive to these follow-on investors. And frankly, that's something you as founders need to always be thinking about. Getting your first seed stage check is only part of the puzzle. If you can't raise your A, B, and C or whatever you require after that, you're going to be dead in the water. So it needs to be attractive, not just to seed stage investors, but also these later stage investors. Next slide. Okay, I'll turn it over to Mark. Yeah.
Yep. All right. Great. Thank you, Jim. As Jim said, we're going to save time at the end to do Q&A. If you think of a question now and you want to just put it into the chat or the Q&A button, that's fine. We'll look at those as well. But we'll also, if we exhaust those, go through asking people to raise hands and do them live. So when we talk about financing of startups, it's really about runway. And in the startup context, this means the time remaining before the cash runs out for the startup company. And hopefully before that happens, the company will either raise its next round of financing and or it will have lifted off the runway to continue the metaphor. And so when we have identified basically 10 sources of funds for startups, some of which are non-dilutive and some of which are dilutive. And so what that means, if it's dilutive, and so we're going to talk at a pretty basic level. So some of you all who have either taken our class or Princeton grad school or have read about venture capital and fundraising, you may be familiar with this, but I'm just going to for everyone else. So if funding is dilutive, that means that it's that the investor is taking a portion of the ownership in the company. If it's non-dilutive, then that means that the founders continue owning 100% of the company. And so it's always good to start with the non-dilutive options if you can before jumping straight into the dilutive options, which I think is one of the core tenets of iCore. So to talk about some of the non-dilutive sources of capital, the first would be bootstrapping, which just means that the company is using its own funds, either those of the founder, him or herself, or from customers, paying customers from cash flow from customers. I would also include within bootstrapping government funding, grants and SBIR grants, as well as incubators and accelerators. And so again, to call out iCore, as Jim had said earlier, we are big proponents of iCore, especially for IP heavy startups. It's really a great source of learning and small source of capital from the regional and then somewhat bigger from the national iCore programs. And then also there's some very good incubators and accelerators, which we've had mixed results investing in companies that have graduated from those, but we've got some very successful companies that went through the Y Combinator or Techstars incubators and accelerators, and we're mentors for the Techstars accelerator in New York.
Can I just add one thing?
Mm-hmm.
Yeah, when I think of bootstrapping, I think of using all of your own resources before you take in outside capital. So some incubators and accelerators do that without actually taking equity, which is really what you should strive for initially, and then really think deeply about whether you want to join a YC or a Techstars, because typically they will take, let's say it's a 6% slug of your equity for a very small check. And a lot of times that can absolutely add tons of value, but you need to think about it very critically, because that 6% is a huge amount of your company to give up at such a low valuation. And the reason why we emphasize bootstrapping as long as possible is because you want to get your valuation as high as possible before you accept outside investors, and therefore you're giving up less equity in your company. And so, for example, if you like, as Mark said, if you can get some customers involved early, that's fantastic, because then you can grow revenue and actually have a much higher value to your business before you accept outside investors.
Yeah, that's a good point, Jim. And I mean, the example we always give of this is there is a company that was founded by a Princeton undergraduate alum called Wyzant, which is a tutoring company, online tutoring company, back in the 2000s. And they basically, just by getting customers and paying customers, were able to build the company up to, I think it was like $50 million in revenue before they took any outside capital. And so as a result, they were in very high demand from venture capital firms to invest, and the founders were able to maintain a very high ownership percentage of that company. And when they ended up selling it, eventually they made a lot more money than they would have if they had gone through, and given up a lot of equity early. Another source of capital for early stage companies that's non-dilutive would be bank loans. Bank loans are great, of course, and I think people are probably familiar with what a bank loan is, and they're non-dilutive, of course, but typically banks only lend against cash flow or assets, and most startups don't have those. So it's not a viable source of funding for most startups. Okay, the next would be a non-dilutive form of funding for startups would be government grants, which many of you are familiar with, and which iCore Hub talks a lot about in the program. But basically, it's a non-dilutive source of capital, and it should be your first, in our opinion, it should be your first source of funding for an IP-heavy startup. I guess the caution is it can only be used for R&D purposes and not for sales and marketing purposes. So if you're ready to start commercializing your technology, you can't rely on SBIR and other government grants for that. Okay, so equity. Equity is what most people think about when they're thinking about raising money for their company, because equity is really the same as stock, which is ownership of the company. And so when a startup brings in outside investors to help fund the company, they're selling stock, which is ownership in the company, to those investors. And equity and ownership of that equity gives the investors a claim on the cash flows of the company and basically ownership in the company, but it's very risky. So the investors could lose, just like the founders can lose all their money if the company goes bankrupt. But the upside is unbounded. So if you were a seed investor in Amazon, even if you invested as little as I think it was $20,000, you became a billionaire. And so there's no limit to how much money you can make, an investor could make as an equity investor, but there is also the downside. It could go to zero. And so startups, which by their nature are very uncertain, have to rely on equity investors primarily for their, after government grants, they need to rely on equity investors for their funding. And then we're going to talk about convertible notes and safes in just a minute. But
sorry, Mark, just not to state the absolute obvious, but the reason why startups have to rely on equity investors is because no bank's going to give you a loan when you have no assets and nothing that they can really get collateral against. So I'm sure most of you realize that, but that's why you're taking in equity investors as opposed to lenders. Right.
And so convertible notes and safes we're getting ready to talk about are really, although despite the names, are more like equity than debt, more like equity than loans. Okay, so a convertible note. Typically they have a fixed term of 12 to 24 months and an interest rate just like any other kind of loan. But investors use them because they convert into equity under specific conditions. And that's usually when the startup raises another round of a price round where they're selling stock in the company to outside investors, then the convertible notes would convert usually at a discount to the price of the next round. Discount typically is 20 to 25%, and with a cap that sets a maximum pre-money value at which the convertible note investors will convert into that round.
And sorry.
Go ahead.
I was going to say, yeah. And the goal, at least us as seed investors, and we do a lot of investing in convertible notes, the goal and the expectation surely is that when we go into these convertible note investments, we always expect that the projections that we've been shown and everything else indicate that when the Series A or the next round after us is raised, it will be in excess of the cap. And so our upside will be more than this discount. The discount is kind of downside protection in case the company doesn't hit its projections and therefore is raising, let's say if the cap's at 10 and they actually raise at 8, which would be a huge disappointment, it still allows the early investors to get some upside, meaning they would get a 20% or 25% discount to that 8 million. But really what they're banking on is getting the next round well in excess of the cap and having a much bigger gain on that 18-month hold period.
Right. And the other thing is that a convertible note investor, if their note is paid back like a loan, then that's a very bad outcome because, venture capital firms and other investors, they want to generate a multiple on their investment. So if they invest $100,000, they want to make, $1 million or more on that investment. They don't want to make 100,000 plus, an 8% interest on the loan. That would be a very bad outcome. Another form of equity investment in a startup would be what's called a SAFE, which stands for Simple Agreement for Future Equity. This is a creation of Y Combinator, the accelerator on the West Coast that's now somewhat ubiquitous. It's similar to convertible debt, but it doesn't take the form of debt on the balance sheet, and it's not on the cap table. It doesn't have a lot of the sort of terms that a convertible note would have. And so as a result, many investors, especially institutional investors, venture capital investors, don't like safes, but it's still very common for early stage startups to raise pursuant to a safe.
What I would say on that is, don't believe the hype that safes are easier to do than a convertible note. If you go to the Cooley website or any law firm's website, they have a convertible note downloadable. And that is something that really barely needs to get negotiated. So there's really no advantage to a safe. People say it's faster and easier and cheaper. Not true. And most savvy, at least institutional investors, won't do safes because it's a made-up instrument that you have to specifically ask for, meaning it's not on the company's financials, as Mark pointed out. And it's kind of a lazy way to take money into your company, I think, personally.
Yeah, I would agree. And the reason that startups use safes and convertible notes versus just issuing equity is that there's a perception, at least, and it's probably true, that they're easier. The transaction costs of issuing a convertible note or safe are lower than issuing preferred stock, which we're going to talk about in a minute. And also they allow fundraising on a rolling basis. So you don't just have one day of closing where you're raising money. You can issue convertible notes sequentially over time and sort of get started with building the company and not wait on a single closing date. And I guess they are very useful. Both convertible notes and safes are useful for very early rounds of the company where the valuation, it's hard to determine a valuation and the company doesn't really have operations and it's difficult for investors to value the company, and also for bridge rounds. The only caution I give to that is that the whole valuation question, which we're not going to really talk about in depth in this call, but we're happy to answer questions about it, is that the cap, many investors consider the cap to be the valuation, or at least a proxy for the valuation. So even though it's not formally setting the valuation of the company, it is sort of. Okay, so now we get to preferred stock, which is the security of choice that in venture capital investment. Preferred stock it can be complex, it can be simple, but it can also be complex. It comes in many flavors. And sort of the terms of that preferred stock are very important and beyond the scope of what we're going to talk about today. We could do a whole session about preferred stock, but But I guess needless to say, once a startup is ready to raise preferred stock, they need to have outside legal counsel, who would advise them about those different terms and flavors of preferred stock that they'd be issuing. And preferred stock does set the valuation of the company. So that when a company startup issues preferred stock, they're setting the valuation. Investors are buying stock in the company at that valuation, and they own a percentage of the company based on how much they invest at that particular valuation.
One thing I would say about preferred is that you typically see it, that the seed stage is typically going to be either preferred or a convertible note, but then definitely by the time you get to the A, it's a priced round, meaning it's a preferred stock issuance. And to be honest, I think most of our deals have started to become preferred stock price rounds even in the seed stage. And there's a really good reason for that. It does cost a little more money to sort of get the paperwork done, but you as founders, if you become founders, you should like it because it protects you in a way that convertible notes may not. So for example, we see it often where people are just, like Mark said, you can do rolling convertible notes, and that is an advantage. But if you don't stop the rolling period, let's say it's 6 months, a lot of startups find themselves issuing too much in terms of convertible notes, and they're raising too much money. And then later, when they go to actually raise a priced round, let's say they've raised 5 million in convertible notes, and then the round is only priced at 10. What happens is the equity owners get squeezed, and those owners are the founders. And so you don't want to be in that position. So a lot of times, we have to explain to founders that this is in your best interest to get your round priced as soon as possible, so you lock it in and you're not finding yourself in a squeezed position where you've issued too much convertible debt down the road.
Yep. Good point. And I guess one thing I didn't point out is that so the founders and employees of the company typically have own or have options to own common stock in the company, and preferred stock that investors buy sits higher on the cap table. It's paid out in the event the company sells, it's paid out in preference to the common stock. So the more preferred stock there is, the less money the common stock investors will get. All right. So some typical sources of equity. So these outside investors who would be buying either convertible notes or safes or preferred stock would be the first sequentially is usually friends and family. And and we sometimes get the question from startup founders who are like, well, I come from very modest means. I don't have wealthy, family members who can fund my company. And that's totally fine. That's obviously very, very common. But later investors, especially institutional investors like Fitz Gate, like to see that friends and family have invested in the company, even if it's a very small amount of money, because it creates skin in the game for the startups. If grandma has invested, $2,000 in the company, the founder is going to be much less likely to just walk away from the company and abandon the other outside investors because they'd be also losing grandma's money. So, having that skin in the game is an important factor, can be an important factor for later institutional investors, but taking money from friends and family can also create conflict. So you need to, as a startup founder, you need to be very clear with your friends and family that although you expect the company to be successful and them to make lots of money, they could also lose all their money that they invest with you. So make sure you're prepared for those kind of discussions with your friends and family.
Yeah, and also I would say add to that, when you do that, if you do a convertible note or even a safe, make sure you're being extremely fair to them. Don't think, oh, I've got to set the valuation artificially high to make it look good when I go raise the seed round. We see that sometimes, and we're just sort of flabbergasted because those are the people who are taking the most risk. So when you set the cap or you set the terms of that investment, make sure it's very fair to those people that are closest to you.
Right. Yeah. Also flabbergasted because they're the ones presumably who love you the most, and so you don't want to. You don't want to abuse that love and trust.
But just to accentuate what Mark said, I think it's important to have some of this. Like, it doesn't have to be even family. Let's just say friends close to you or people because there was this culture in the last 5-10 years where it was like, hey, fail fast, et cetera, and everybody's an entrepreneur today, and there's really limited stigma, people think, to failing and going to do the next thing. But when you're going to raise money, you want to be able to convince people 100% that you will not quit and that this will not fail. And honestly, most of the time, the reason why startups fail is simply because the founders throw in the towel. And so when you have people that are close to you having invested, it's a good sign that you're taking this very seriously.
Yep. Another source of equity, typically after friends and family invest, are from angel investors. These are typically wealthy individuals who may be geographically located where the startup is. They could have some other connection to the startup, such as their fellow alumni of the same university, or they come from the same industry, or so they're different angel groups focused around different groups like that. Angel investors, typically they want to invest in convertible notes or safes because they don't want to spend a lot of time or money negotiating terms. They're typically going to be limited support for the business. They're usually just money, and they're not going to be helping the business grow in the future. They're probably not going to be doing much due diligence either. Some examples are Angel List, which is a website where angel investors go to try to find deals. There's a group focused around the Princeton University alumni system called the Princeton Alumni Angels. And I guess, again, just like friends and family, sometimes we've seen startup founders who want to sort of take advantage of angel investors' limited sophistication, at least as startup investors. They may be very sophisticated in their other areas of their life, but in this area, they're usually less sophisticated. And to raise the money at a higher valuation, the company could justify. And again, we would caution against that because and if you raise money from angel investors at a very high valuation and an institutional investor comes in and invests in the next round at a lower valuation, then those angel investors, as well as the founders, are going to get squeezed. And that's sort of a bad look and bad fact for everyone involved.
Yeah. And also a lot of times VCs are going to be less excited about investing in a company if they know they have to basically cram down angels. It's just distasteful. And so unless they're really, really excited about your company, you just increase the chances that they might walk. And then on the angel list, angel groups, check different university systems. Like Harvard has obviously a very active angel group as well. Not sure about Rutgers. I assume most schools today have alumni that are interested and have formed angel groups. But each city also typically has big angel groups. In major metropolitan areas, there typically are at least one sort of well-known angel group, and you should absolutely tap into those groups because they're always looking for good companies to pitch, and certainly deep tech is always attractive. So,
another source of equity investor is strategic investors. So that's often very appealing to startup founders. They say, well, if the big company in my particular industry wants to invest, that's validation of my idea and the company I'm building, and that may be true. That can be a good sort of indicator, but be very careful about taking money from strategic investors, because what that can do is, especially if they have rights to sit on your board, if they have rights to information about your company, number one, they could steal the information and create a competing company, although that would be a violation of some different laws, but it does happen. But also, and probably more likely and more importantly, is that it could cause later professional investors, VCs, and then ultimately acquirers of your company to not be interested because, if a big company, a strategic investor in your industry has information, ownership rights in your company, then one of their competitors isn't going to be as interested in buying your company because they would think, any other acquirer would think that they're an information disadvantage and they wouldn't know how to price the acquisition of the company properly, and they would be afraid that basically the internal strategic investor who had been involved in the company for a while had some kind of knowledge that they weren't aware of, and that was reducing or reducing the price at which they would buy the company. So just be very careful about taking money from strategic investors. And then the last sort of source of equity is venture capital, which Jim will talk more about now.
Okay, thanks, Mark. So venture capital is really what we do and what you're probably mostly all thinking about. It's really what Mark Andreessen refers to as a game of outliers, meaning it is very high risk, but also, as Mark said earlier, uncapped upside, so huge potential. And so when we think about venture capital, the thing first to think about is, do you even need venture capital? And, we'll get to another slide where we show most businesses in the United States and the world don't need venture capital. And you as a founder can start a business and make many, many millions of dollars for many generations of your family without ever raising venture capital. The companies that really require venture capital are the high growth, highly scalable companies that really can't generate the growth without an influx of outside, an infusion of outside capital. And when that happens, it tends, one obvious example is software. You can scale software very quickly. But when we look at companies, one of the first things we look at is, one, is this a venture capital backable company? Meaning, does it even need venture capital? The projections that the company set forth in their financial statements, does this kind of growth require this kind of large equity investment? And if it does, then we look to see what the returns look like. So a typical seed stage investor is going to look for a return in the 10x plus range. Now, you can say that looks greedy or sounds greedy, but you got to remember that when seed stage investors are investing, typically there's often no customers. Sometimes there is a product, sometimes there isn't. For example, in our quantum computing deal, if there is a product, is there product market fit? Sometimes there is, sometimes there isn't. So there's a huge amount of risk. And in return for taking that risk, the venture fund has to make an assessment. Is there a potential for a 10x plus return? Because when you look at a typical structure of a venture capital fund, most funds look at the math this way. They say, we're investing, X million dollars out of our fund. A third of those deals will probably be zero because we're taking this risk. A third will probably return some capital. And then the third will be quote unquote winners. And there are different philosophies around this. We've been fortunate. We have a much higher ratio of success than that. But that typically, that kind of a scenario generates a 20 to 25% IRR over 10 years for most venture funds. And that's kind of the norm. You do have people like Peter Thiel saying that, he won't make a venture investment unless it can return his entire fund. And his funds are, hundreds of millions, if not billions. So he's only investing in companies that can become unicorns. Whereas, for example, Fitz Gate, we love unicorns, but we invest very early. So if we can get a 10x, that sometimes might mean that the company could exit as low as 100 million, and we might get the return we require, which you as a founder should think about, because you don't want to be under pressure to have to be a unicorn. It's great to be a unicorn if you can, but typically there are a lot of ways to make money that don't require it and have exits at much lower valuations. Last point on this slide is that people don't realize it, but most successful exits of venture capital backed companies are in the 80 million-ish range. So, you read the papers about, all these big successes that are unicorns, but under the radar are the vast majority of startups that are doing great and generating great returns, but they're exiting at sub billion-dollar valuations, and that's perfectly fine.
And just to sort of double down on the comment about game of outliers, although Mark Andreessen is someone of a blowhard, he actually, I think he's correct in this sense that a startup to be very successful and very scalable and to grow at the rate required to generate this kind of 10x return doesn't just check the boxes. They have some kind of superpower. They have some kind of outsized advantage that will allow them to grow very fast, whether it's a technology, some unique technology that they own and have patented. It could be a unique founder who's super dynamic, or founder group. It could be some kind of approach to the market or some initial customer base that they have that's going to give them an outsized advantage. And so just checking the boxes is usually not enough.
Yeah, last part on this slide is just that, you would fully expect your venture capital investor, not your angel, but when you go to an institutional fund like ours, that they will either take a board seat or a board observer seat, which is fine. Oftentimes, early stage companies don't even have boards, and that's okay too. But you can expect quite a bit of involvement from the VC, and that you should view as a positive, because obviously you need all the help you can get. It may come in the form of introductions to other sources of capital, or it may come in the form of introductions to potential customers or advisors. And so when you're looking for capital, be sure you also make sure that you kind of have alignment with you, the people that are going to be specifically involved from the venture firm that's investing in you, because that's a really long-term relationship. Venture funds typically at the seed stage are your partners and investors for 5 to 10 years, and so choose wisely. Next slide. So we talked a little bit about this already. One of the things when we think about seed stage investors, I guess I would say is there are some VCs that say all that matters is the team. It's really not about the idea. That's one point of view. I do think that's certainly a valid point of view, because oftentimes we make assessments on founders based on not just the team, but we absolutely look at the technology. But we also want to know that if there's been a miscalculation in the market assessment or the go-to-market strategy or product market fit, that this founder can pivot and fix it if it doesn't work. And that's a great trait in a founder. So I think focusing on you as the entrepreneur is something that most early investors are going to pay the most attention to. But then I think one of the things, I think it was Mark's, the first slide in the introduction about what iCore is saying, which is, make sure this is a problem that needs to be solved. I think one of the downsides to all of these seminars and all the entrepreneurship programs at universities is that everyone, there's no stigma out of being an entrepreneur. As I said earlier, when I got out of college, nobody was entrepreneurs. There was no clear pathway. Now it's kind of prestigious, and you find people starting companies that really shouldn't start companies. The other thing I'll say is that this audience is in a much better position, because having sort of IP and something proprietary is absolutely a huge competitive advantage. We see companies all the time where we just say, this isn't a problem that needs to be solved, so we move on. But I think if you're looking at university IP, that is really interesting, and not every Tom, Dick, and Harry can do that. Anything else?
I guess one other important factor that VCs consider is sort of the time to growing the company. So, a typical VC firm has a 10-year life. VC firms themselves have investors called limited partners who want to return on their capital, and that's usually over a 10-year time frame with maybe a couple 2, maybe 3-year extensions. And so a company needs to be able to grow and exit, meaning sell the company or IPO, within that 10 to 12-year time frame from when the VC invests. And so if you have a company that's going to take a very, very long time to get a product to market and then to grow the company, that may be great for you, but it's probably not going to be so great for the venture capital firm. And so in that case, like again, the quantum computing example, we knew when we invested it was going to be many years before a quantum computer this company was going to put a quantum computer on the market. But we thought that the potential returns on that the growth rate, once it did have a product on the market, were going to be unusual and outsized, and that would provide an outsized return, even if the time period was long. But that's the sort of analysis that the VC firm is going to make.
Yeah, even on something like quantum is a great example. Okay, well, maybe within that 10 to 12-year period, maybe the quantum computer and the software it's a hardware and software play. Maybe it's not fully baked, but we've made sure the founders are both receptive to an exit during that timeline, and that there are opportunities for exit during that timeline. So you might be working on something really phenomenal, deep tech, that's going to take a long time, but you as the founder always be attuned to, if I'm going to take venture capital in, be thinking in that sort of 10-year time horizon, and make sure in any pitch you give, you address exit. Because sometimes we do get pitches where, it gets the exit, or it's not even mentioned in the deck. And we ask, and the founder's like, oh, I haven't thought about that. That's the worst thing you can say to somebody who's looking to give you money. They want their money back. It's not a hobby. So think about that. And it's perfectly okay to say, if we don't go to market, like a lot of biotech companies do this. They have no plans to build out a sales force and sell a drug in the market. They want to get FDA approval, and then they sell, 5 years later. That's okay. That you can make a lot of money that way. Okay, next slide. Okay, so this is kind of a matrix which Mark loves, and I'm loving now as well, which is thinking about what I said earlier. Do you need venture capital? It's not just a reflexive thing. Yes, I want it because it's trendy and it's easy and believe me, it's plentiful. There's tons of venture capital out there, but most businesses, small businesses. So if you look at these axes here, it's kind of on the one side, you've got on the y-axis, you've kind of got, how much capital is required. And then you've got sort of on the x-axis, sort of what's the novelty and the newness of what's being proposed. So in that bottom quadrant, small businesses, this is the vast majority of businesses that are starting in the US today that I referred to earlier, where you can all get very rich, absolutely, intergenerational wealth. I mean, something like this, an obvious example is, I don't know, car dealerships. Those can sell for billions of dollars. They don't need venture capital. You can start one of those with a bank loan. Okay, the next quadrant. Okay, so at the top here, capital intensive, proven technology, something like project finance. I think a great example here is when we think about, my wife used to work for a big company called Cheniere, liquefied natural gas. When you build those facilities, they require tens of billions of dollars. But you don't need venture capital to do that. What you need is project financing. So if you're building a massive project, which is typically an infrastructure project, the way you can raise money is unlike a startup that you guys are probably thinking about, a software company, for example. You can't get a bank loan. You have nothing to lend against. But if you're doing a big project financing, what they lend against is few customers will basically sign contracts, oftentimes for 10-year periods, saying, if this facility is built, we will agree to offtake your product for this 10-year period. And then the company turns around and basically shows those contracts to the banks, and the banks lend on it. And that's what's traditional project finance. Any big infrastructure project is financed that way. Okay, next quadrant. So this is where what we've been talking about. And this is where really you require, quite a bit of capital, but not massive amounts of capital. It's innovative and a novel, technology. And that's really where venture capital is best suited. The top quadrant next, these go to the next slide, Mark.
I think that's it.
Oh, did I talk about the top right? I may miss it. The capital. So the top right would be things like, a great example for that is fusion, where nobody's really certain there's ever going to be a product. And you can't get project financing because even a customer there's no way that they can even foresee, an offtake agreement at that point. And so that's where government funding really steps in, something like that, where a lot of capital is needed. It's good for the world. It's absolutely going to happen, but nobody is sure. I mean, the joke about fusion is it's always like 5 or 10 years away. And so that's a unique category of startup. Okay, next slide. Okay, so we had a whole section here where what to put in a pitch deck, but we understand you did that last week. So here's just kind of a high level overview of what I think we just talked about, which is basically bootstrap as long as possible so you can create as much equity value for yourself before you start giving away pieces of your company. I mean, you should be thinking about, you say, oh, I'm only giving away 1%. 1% is a huge amount of your company, especially if you think it's going to be successful. Friends and family, Mark talked about that, how to think about valuation very fairly, very low valuation. And just to grossly generalize, any friends and family valuation, low single digit cap or low single digit, equity valuation. Accelerator, incubator, that's a long discussion. There's some that don't take equity. Some like YC and Techstars do take quite a big chunk of equity for a very, very small check, but also potentially a lot of value in terms of the network. You step out of YC, there are angels just waiting to throw money at you. And that's another we could have a whole discussion about that. Is that good or bad? That doesn't mean it's going to make it any easier to raise your real institutional round. So those things you need to think about critically, whether it's worth the juice is worth the squeeze or whatever. Angels and advisors we talked about. One thing I think it's obvious to talk about is not just angels, but advisors. Everyone's eager to get advisors and they're excited when they get a brand name to be an advisor. And this is a good, just grossly general metric to think about. When your advisor comes in a perfect world, they're making investment with their own money, as an institutional fund. That's the best kind of advisor to see in the company, one who's put their own skin in the game, but who also, for their work is going to get some equity. And the way that we think about it is kind of 25 basis points vesting over, and this is at a seed stage company, kind of 0.25% vesting over 2 years is how you should think about it. We see a lot of startups that give way too much equity to these advisors. And if you don't have it vesting, you're making a huge mistake, because they might agree and you have 1 or 2 phone calls, and then all of a sudden they're not doing anything for you because their day job is CEO of some major software company, and they're not being mean, they just don't have the time. So I think you need to think about it vesting not over 4 years like an employee, but like over 2 years, and make those kind of small slugs, because 25 basis points in your company is going to be worth many millions of dollars if you're successful. Seed stage. And then the way to think about the VC model is, you got your seed, your pre-seed, your seed, and then there's usually an 18 to 24 month cadence between rounds, just grossly generalizing again. In this environment, you probably want to have at least 18 months of runway between rounds. So if you're raising money, make sure you're raising enough to last you 18 to 24 months, because it's very hard to raise capital today.
And that's changed just in the last year. There was some data was released just yesterday that the average time period between seed round and Series A, and between Series A and Series B rounds, has gone just in the last year from about 13 months to almost 19 months. So as Jim said, you really need to raise at least 18 months of runway.
And if you're going to sustain the brain damage to go out and actually do a proper fundraise, take as much money as you can. Sometimes we'll hear founders say, well, it's oversubscribed, but I don't want to give up that much equity. Horrible decision. If your company is really going to be successful, it doesn't matter whether you're taking in $1 million or $2 million at this early stage, and you're much better positioned because, for example, nobody foresaw COVID. Think about how many companies went out of business during COVID. The ones that survived tended to have just gotten dumb lucky in terms of when they raised their last round. Okay, and then the A, B, and C is kind of the way we think of venture capital. As you get into those D rounds and beyond, that's typically referred to as growth equity. And those venture funds start to look much more like private equity funds, because they're investing on the basis of EBITDA, cash flow, and all the things that we don't even have on the horizon when we're investing. Okay, Mark talked about strategics. That's another, we could talk a whole half hour about that. And then the one thing I'll say about burn rate and runway and cash flows, KPIs, key performance indicators or metrics, is they're changing, So just the way that the runway is getting longer today, KPIs are changing. It's not enough to say, hey, we want to do an Uber strategy and get in every city as quickly as possible, and we're going to be cash flow negative until the cows come home. You need to be showing, even as a later stage company, we have a clear pathway to being cash flow positive. So be thinking about those KPIs as you start your business. And
hey, Stephanie, how I know we're getting about 5 minutes to the hour. How long do we have for Q&A?
Oh, yeah.
You're muted. I couldn't hear you. Stephanie, you're muted.
I think we have maybe about 2 more minutes for the talk, and then we'll open the floor for question and answer.
I think we're done. Let's just go.
Yeah, we're done with the
Okay.
talk. And so I was looking
Great.
at the chat. Should we just take the questions
there's
from the
a
chat?
lot of great questions. I open the floor. Who wants to go first?
I asked if our folks could put their questions in the Q&A. So Mark or Jim, if you want to look through scroll through the Q&A questions, I answered what I could about the iCore stuff, but they have some good questions in the Q&A.
Well, I was just looking at the chat. It looked like there's several questions about valuation. Sort of what is expectation around valuation, like from a cap and between rounds. I would say that an institutional investor, a VC investor would expect at least a doubling of the valuation between rounds, and hopefully more than that. And so, if you do an angel round with a cap, a convertible note of $5 million, or if you issued preferred stock at $5 million valuation, then the investors in that round would expect the next round to be at least 10, hopefully more than that. And so you should be thinking about sort of that, I think, range between rounds. And let's see, Jim, are you looking at these two?
Yeah, okay, I'll take one. Hold on, let's see. Someone asked about how do you find angels? And does geography matter? I would say geography does matter. Part of the reason why being an angel is, you better be rich to be an angel, because most of them don't make enough investments to have a portfolio approach to it. And so when I think about angels, they're doing it for the experiential just as much as the return. In fact, we know one angel quite well who, he once had invested in a company and showed it to us, and we passed on it. And then we had a meeting with him and we said, hey, look, we respect your judgment as a great business executive and very wealthy person, but we don't agree with the hypothesis here. We don't think it's going to be a successful business. And this angel's response was, oh, I don't even care if I get any money back. I just really like the guy and want to help him out, or her, or whoever it was. And so their interest was experiential, listening to the business, getting involved. And so you'll find that. And so I'm saying that because that does make geography a little more relevant. If you can find an angel group that meets in your neighborhood, for example, I'm in Houston. There's a big Houston Angel Network, and they meet for breakfast once a month. And it's a social thing too. There are probably 100 members. They have a really nice breakfast at 7 a.m. once a month. They have a full-time person that screens deals. And so I think it is important. So I would look in your city. I'd look at universities near wherever you're located to see if they have. That's becoming much more popular. Mark mentioned Princeton Alumni Angels. That formed about 5 years ago. The Harvard Angels have been around even longer, but I think a lot of schools, alumni groups are beginning to do it more and more, and that'd be a natural place to look.
Yeah, and it's a lot of the angels consider it investing in startups as sort of an experiential, fun thing to do that they can go then brag about to their friends. And so geographic proximity does matter. Looks like Eugene Major had some questions about university licenses and terms around those licenses. I would say it varies by university, and it also varies by industry. So, a software company spinning out of a university is going to have different license terms from the university than a biotech company, for instance. But usually we've seen, and Eugene, I believe, is also affiliated in some way with Princeton. I think I've seen your name before. We've spoken, Eugene. And so Tony Williams at Princeton is very professional and fair around university licensing of technologies. So I think you can rely on him in that regard.
Yeah, I think all universities are getting with the program today. It used to be every negotiation was bespoke and a painful negotiation. The savviest universities are realizing this isn't about return, it's about opportunity for our faculty and our grad students, and building a reputation that ultimately will result in money to the university as well. So to grossly generalize, I'd say low single digit equity percentage is fairly typical these days, and or low single digit royalty that might fall away within either 3 years or a sale of the company, something like that. But if you're negotiating, on a recreating the wheel basis at a university, that's more and more unusual, and you'll sustain quite a bit of brain damage with that. The other thing I'd say to all of you on the call is, you may have your own technology you've developed out of a university lab, but I also encourage everybody on this call, even if you don't, there is so much IP at every major university in this country that's just sort of sitting in a filing cabinet. And all of these groups, the tech transfer offices, welcome anybody to come in to consider licensing that tech. Now, I think it's a really great strategy for somebody who wants to be an entrepreneur, but maybe doesn't have an idea of what they want to do. And
then one, I know we're right up against the time. Just one more question. Vidor asked about what KPIs or literature do you suggest? So Jim and I teach a class on venture capital and startups at Rice University here in Houston. And we have readings associated with the class. The two that are always the best received, and I think are the best, are Peter Thiel is probably the most successful angel investor at least in modern history. Whatever you think about his politics, he is an amazing angel investor, early stage investor. And he wrote a book called 0 to 1. Which is short, easy to read, and very instructive, both from what an angel investor looks for and what a startup founder should build towards. And then a similar book, I wouldn't recommend it quite as highly, but is a book called Angel by Jason Calacanis, who's also a very successful angel investor, and it's a pretty good description of what early stage investors are looking for.
Yeah, I can't remember the name of the author, but I think Secrets of Sand Hill Road is almost like a textbook for VC. So in terms of KPIs and things like that, I would really recommend that one. I think it may have been written by an Andreessen partner. Is that right, Mark?
Right. Yeah, Mitch Kapoor.
So I really recommend that one, Secrets of Sand Hill Road. Keep in mind, KPIs are changing in real time. This is a very fluid environment that we're in right this second. So, we have a company that's ready to go public and was waiting to go public last fall when, when the IPO market basically shut the door. And even a company at that late stage that's a unicorn is readjusting its own KPIs all around profitability, which is something that, earlier in their life cycle wasn't something that was even valued. So I would recommend newsletters. Read a lot of newsletters, and you can Google and find some. We can also recommend some offline.
Great. Thank you so much, Mark and Jim, for the very insightful talk. We're so lucky to have you both. And I'd like to turn over the floor to Mark DeGuzman to quickly announce the upcoming events happening at NSF I-Corps. Go ahead, Mark.
Thank you, Jen. Thanks for bringing it back to me. I just want to make a final reminder that the Clean Tech Propel Us I-Corps program, the deadline is coming up soon, June 19th. So definitely submit your application. I'll send you the links in the follow-up email afterwards. The standard Propel Us I-Corps program is going to be, application deadline is June 29th. We do have an info session next Wednesday on June 21st. So I'll send you all these links in the email. So look out for those. If you're interested, definitely reach out. But basically, we want to thank our speakers. You can always learn more about Fitz Gate Ventures, check out their website. If you have a really serious startup company that you really want them to evaluate, you could potentially send them a pitch deck here. But if you just have a simple idea, then maybe wait until a later stage, because you want to definitely go get on the right foot with them. Also, please sign up for our Hub newsletter, which is on the top right. If you go to the I-Corps northeasthub.org website, at the top right, it says sign up for our newsletter. You'll find out more about these opportunities. And just for those teams who do have a healthcare innovation, we are planning to have a healthcare cohort in the fall. So look for that to be in the future. And Stephanie, I'll shoot it back to you for the final slide.
Perfect. Yeah. And thank you all so much for coming. And we'd like to announce our next speaker for Entrepreneurship Essential Series. We'll have Mike Rinkunas. He is from Big Idea Ventures, and he's going to share with us about building minimum viable product. It's going to happen in September 20th, on September 20th at 11 o'clock as well. And we look forward to having you there. And thank you so much again, Jim and Mark, for the very insightful talk. We're so honored to have you. Thank you. Thank you, everyone.
Okay. We can stop the recording if anybody wants to stick on to answer questions, because I know Jim and Mark wanted to get through their slides, but I'm sure if you have time, Mark and Jim, if you want to stay on to answer a few more questions for just 5 minutes, we can stop the recording now, though.